When you're financing an investment property, two loan types come up more than anything else: conventional investment loans and DSCR loans. Both are solid options. Both can help you build wealth through real estate. But here's the problem: a lot of investors pick the wrong one. Not because it's bad, but because it doesn't match their situation or long term strategy. In this video, I'm going to break it down: how conventional investment loans work, how DSCR loans work, the real pros and cons of each, actual number examples so the math makes sense, and how to decide which loan fits your goals. Not what TikTok says you should use. What is a conventional investment property loan? A conventional investment property loan is a traditional mortgage used to buy a rental property. These are the same loan programs used for primary residence, but with stricter guidelines because the property is not owner occupied. Key characteristics: qualifications is based on your personal income. Lenders calculate your debt to income ratio, also called DTI. Down payments are typically higher than primary homes. Interest rates are usually lower than alternative investment loans. Properties are financed in your personal name, not an LLC. From an underwriting perspective, these loans are very conservative, which is why they're cheaper. Let's put numbers to this so it's not abstract. Example: a purchase price of $500,000 with a down payment of 20%. It's a loan amount of $400,000. Let's use an interest rate of 6.75. Your principal and interest is $2,595. Taxes and insurance, let's call it $700. Your total monthly housing payment of $3,295. Now the lender looks at you, not the property. Let's say your gross monthly income is $10,000. Your current monthly debts, this would be your car, your credit cards, your student loans, is $1,500. Your current housing payment is $2,800. Your proposed rental income is $3,600. Then we'll use the 75% factor, and that will equal $2,700. Your total monthly debt is $4,300. That would be your monthly debts plus your current housing payment. Proposed mortgage, $3,295. Subtract the $2,700 of rental income, gives us an extra debt of $595. So our DTI calculation would be $4,300 plus $595 equals $4,895. Divide that by $10,000 monthly income, and our DTI is 48.95%. If that DTI fits within guideline limits and your credit is strong, you qualify, even if the rent barely covers the payment. We'll need strong compensating factors such as high reserves and great work history for that DTI. That's the key difference. Conventional investment loans work best if you have strong W-2 income or clean self-employed documentation. Your debt-to-income ratio is solid. You're buying 1 to 4 unit properties. You want the lowest possible interest rate. You're comfortable holding properties in your personal name. These loans are great for first-time investors, buyers with stable income, investors buying 1 or 2 rentals and holding them long-term. But once your portfolio grows, conventional loans can become restrictive. What is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. Unlike a conventional loan, a DSCR loan does not qualify you based on your personal income. Instead of asking, "Can you afford this property?" the lenders ask, "Can the property pay for itself?" This is a major shift, and it's why DSCR loans are popular with investors. Here's a real life math example. Let's use the same property and see how DSCR works. Purchase price $500,000. Down payment 25%. Loan amount $375,000. Interest rate, let's call it 7.75. Your principal and interest is $2,685. Taxes and insurance $700. Total monthly payment $3,385. Now instead of income and DTI, the lender looks at the rents. Let's say market rent is $3,600 per month. The DSCR calculation is $3,600 Divide that by $3,385 equals 1.06% DSCR. So keep in mind, with the DSCR, we use 100% of the total rent to qualify. Now, here's where the lender tiers matter. DSCR pricing tiers, 1% and above, best pricing. 0.75 to 0.99, that's tier 2 pricing. Higher rates, more restrictive terms. Below 0.7% equals no ratio. DSCRs, also known as tier 3, higher rates, largest down payments, used when the deal is strong but cash flow is weak. So yes, DSCR loans don't require traditional income documentation, but the numbers still matter. The better the DSCR, the better the terms. This is why DSCR loans are easier to qualify for, but not always cheaper. You're paying for flexibility, speed, and ability to scale. DSCR loans, pros and cons. Pros: easier qualification for investors, ideal for self-employed borrowers. No personal income documentation in many cases. Easier to scale rental portfolios. Can close in an LLC. Cons: higher interest rates than conventional loans. Larger down payments. Prepayment penalties are common. Rates are more sensitive to DSCR ratio. The DSCR loans trade costs for flexibility. Here's a side-by-side comparison. Here's the clean breakdown. Conventional investment loan. Lower interest rates based on personal income and DTI requires full income documentation, limited number of finance properties, slower portfolio scaling, must close in personal name. DSCR loans, higher interest rates based on rental income, no traditional DTI calculation, easier portfolio growth, more investment flexibility, can close in an LLC. Neither loan is better. They're built for different strategies. Which loan should you choose? Ask yourself, do I want the lowest rate or the easiest qualification? Am I buying one property or scaling a portfolio? Does my personal income help me or hurt me? Do I want to own a property in an LLC? A lot of smart investors start with a conventional loan early, then transition into DSCR loans as they scale. Here are my final thoughts. Investment financing isn't one size fits all. The best loan isn't always the cheapest. It's the one that supports you long term. If you're debating between a conventional investment loan and a DSCR loan, reach out for a deal review. We'll run both options side by side and see which one actually makes sense for your goals. If this video helped you, like the video, subscribe to the channel, and drop your questions in the comments. Future videos are built directly from what you ask.